Let me ask you a simple question. In 2026, who can actually afford a $250,000 house? Not who wants one, not who dreams of one, but who can realistically buy one without drowning in debt? The answer might shock you, and it says a lot about where the economy is heading. 10 years ago, a $250K home felt like a solid middle-class milestone. Today, it is starting to look like a luxury purchase for many families. Interest rates, wages, inflation, and debt have changed the game. In this talk, I'm going to break down who can truly afford a $250,000 house in 2026, what income you really need, and why millions of people are being priced out of homeownership. The real question is not whether a $250,000 house is expensive. The real question is how much income you actually need to afford it in 2026. Most people look at the home price and think, that seems reasonable. But the price is just the beginning. What matters is the monthly payment, and that depends heavily on interest rates, taxes, insurance, and your financial profile. In 2026, mortgage rates are much higher than what people were used to in the 2010s and early 2020s. Back then, you could lock in a loan at 2 to 3%. Today, many buyers are looking at rates around 6 to 8% or even higher. That single change can double your monthly payment on the exact same house. On a $250,000 home, even with a standard 20% down payment, you are borrowing around $200,000. At higher rates, that loan can easily cost you over $1,500 per month before taxes and insurance. Banks also follow strict affordability rules. Typically, they want your total housing costs to stay below about 28 to 33% of your gross monthly income. That means if your mortgage, taxes, and insurance add up to $1,500 per month, you should be earning at least $4,500 to $5,500 per month before taxes. That translates to roughly $55,000 to $70,000 per year, and that is for someone with low debt and a good credit score. But for many people, student loans, car payments, credit cards, and personal loans push that requirement even higher. When you add those debts, lenders often require your total debt payments to stay under about 36 to 43% of your income. So if you already have significant monthly obligations, you might need closer to $80,000 or even $100,000 per year to comfortably qualify for that same $250,000 house. This is why the idea of a starter home is disappearing. What used to be affordable for a single middle-class income now often requires two incomes or a high-paying job. The math is not emotional, and it does not care about your dreams. It is purely numbers. And in 2026, those numbers are telling a very clear story. A $250,000 home is no longer a basic milestone. For many households, it is a serious financial commitment that requires solid income, strong credit, and careful planning. Interest rates changed everything about homeownership, and most people still underestimate how powerful that shift is. When people talk about house prices, they usually focus on the sticker price, but the interest rate is what quietly determines whether a home is affordable or completely out of reach. Two buyers can purchase the same $250,000 house and end up paying dramatically different amounts over time, simply because they locked in different rates. Think about how mortgages worked in the past decade. For years, rates were extremely low, sometimes close to 2 or 3%. At those levels, borrowing money was cheap. Monthly payments were manageable, and buyers could stretch their budgets without feeling the pressure too much. A $200,000 loan at 3% feels very different from that same loan at 7 or 8%. The difference is not small. It can mean hundreds of dollars more every month and tens, or even hundreds of thousands of dollars more over the life of the loan. In 2026, we are living in a higher rate world. Central banks raised rates to fight inflation, and mortgages followed. That means banks charge more interest for the same amount of money. On a 30-year mortgage, that interest compounds over decades. You are not just paying back what you borrowed. You are paying a premium for the privilege of borrowing. For many buyers, the total interest paid over 30 years can rival or even exceed the original home price. This changes behavior in powerful ways. Buyers qualify for smaller loans because monthly payments hit their debt to income limits faster. Sellers struggle to find buyers at higher prices because fewer people can afford the payments. Investors become more selective because returns shrink when financing costs rise. The entire housing market slows down or shifts direction because the cost of money increased. Interest rates also affect psychology. When rates are low, people feel confident taking on debt. When rates are high, people hesitate. They worry about locking in a bad deal, they wait for rates to drop, or they decide to rent instead. This hesitation reduces demand, which can cool down prices in some areas, but it also makes homeownership feel more risky and complicated. For the average person, higher interest rates mean you need either a bigger down payment, a higher income, or a smaller house. There is no magic trick around that. You can negotiate price, shop lenders, or improve your credit score, but you cannot escape the basic math. The cost of borrowing is now a major barrier, not just the cost of the home itself. So when you ask who can afford a $250,000 house in 2026, interest rates are one of the biggest gatekeepers. They quietly decide who gets the keys and who stays on the sidelines watching from the outside. When you apply for a mortgage, the bank is not judging your dreams, your motivation, or how badly you want that house. They are judging a few cold numbers, and one of the most important is your debt-to-income ratio. This is one of the main filters that decides who qualifies for a $250,000 house and who gets denied, even if they feel financially stable. Debt to income, or DTI, is simply a comparison between how much you earn and how much you already owe each month. Lenders add up your expected housing payment and all your existing debts like car loans, student loans, credit cards, personal loans, and sometimes even child support. Then they compare that total to your gross monthly income. If the percentage is too high, they see you as risky, no matter how good your job title sounds. Most lenders like to keep your housing costs around 28 to 33% of your gross income. That includes the mortgage, property taxes, and insurance. On top of that, they usually want your total debt payments to stay under roughly 36 to 43% of your income. Some programs allow slightly higher ratios, but those often come with higher rates or stricter conditions. Here is where reality hits. Many people already have significant monthly obligations before they even think about a house. A car payment, student loans, and a couple of credit cards can easily add up to several hundred or even over $1,000 per month. When you stack a mortgage on top of that, your DTI can quickly cross the bank's limit, even if your salary seems decent on paper. This is why two people with the same income can have completely different outcomes when applying for a mortgage. One person with minimal debt might qualify easily. Another person with heavy loans might get rejected or approved for a much smaller amount. Lenders are not looking at your lifestyle. They are looking at how much of your income is already spoken for. DTI rules also shape how much house people buy. Even if a bank pre-approves you for a certain amount, the maximum approval often pushes your finances to the edge. Many financial experts recommend staying well below the bank's limit to avoid being house poor, where most of your income goes into the home and you have little left for savings or emergencies. In 2026, with higher interest rates and rising living costs, DTI becomes even more important. Monthly payments are higher, so they take a larger share of your income. That means you either need a higher salary, fewer debts, or a smaller mortgage to stay within the acceptable range. The rules did not get stricter, but the environment did, and that makes qualifying harder. So when you hear someone say a $250,000 house is affordable, remember that affordability is not just about the price. It is about whether your income and your existing debts fit neatly into the bank's formula. That formula quietly decides who gets approved, who gets rejected, and who has to keep renting, even if they feel ready to buy. When people think about buying a home, they usually focus on the purchase price and the mortgage payment. That is the number they see in calculators and ads. But the true cost of owning a home is much bigger, and many first-time buyers are shocked when they realize how many hidden expenses come with a $250,000 house. Property taxes are one of the biggest overlooked costs. These vary by location, but in many areas they can add hundreds or even thousands of dollars per year. Some places reassess taxes when a home is sold, so your tax bill can jump right after you buy. That extra monthly cost is added on top of your mortgage, and lenders include it in your affordability calculations. Home insurance is another must-have expense. Lenders require it, and in certain regions, you may also need flood insurance, earthquake insurance, or other specialized coverage. Insurance premiums have been rising in recent years due to climate risks and higher repair costs. What used to be a minor monthly bill can now feel like a second utility payment. Maintenance is where many homeowners underestimate the real burden. Renting shields you from repairs, but owning means you are responsible for everything. Roofs wear out, appliances break, plumbing leaks, air conditioners fail, and unexpected issues show up at the worst times. A common rule of thumb is to budget 1 to 3% of the home's value each year for maintenance. On a $250,000 house, that could be $500 to $700 annually. Many people do not plan for that, and repairs end up on credit cards. Utilities are also higher in a house than in an apartment. Heating, cooling water, trash, internet, and electricity can increase significantly, especially if the home is larger or older. Add landscaping, pest control, and small upgrades, and the monthly costs quietly stack up. Then there are closing costs and moving expenses. When you buy a home, you pay for inspections, appraisals, loan fees, title insurance, and more. These can easily add up to several $1,000s up front. After that, furnishing a house often costs more than people expect. Curtains, furniture, tools, and basic household items add another layer of spending. All of these costs change the definition of affordability. A $250,000 home might seem manageable based on the mortgage alone, but when you add taxes, insurance, maintenance, and utilities, the true monthly cost can be far higher. This is why some homeowners feel financial pressure even if they technically qualified for the loan. In 2026, these hidden costs are even more significant because inflation has raised the price of labor, materials, and services. Repairs cost more, insurance premiums are rising, and taxes often follow property values. Owning a home is still a powerful way to build wealth, but it is not just a monthly payment. It is a full financial system that requires planning, discipline, and a realistic understanding of what you are signing up for. When you look at the housing market in 2026, it becomes clear that not everyone is buying homes. In fact, a specific group of people is dominating purchases, and that tells you a lot about who can actually afford a $250,000 house today. The market is no longer driven by average single-income households. It is driven by people with advantages that most buyers do not have. One major group is dual-income households. When two people earn steady incomes, their combined salary makes qualifying for a mortgage much easier. Lenders look at total household income, so two average earners can often qualify for a home that would be impossible for either person alone. This is one of the biggest shifts in modern home ownership. What used to be affordable for one earner now often requires two full-time incomes. Another big group is high earners and professionals. People working in tech, finance, healthcare, engineering, and other high-paying fields still have the income to buy homes, even with higher rates. For them, a $250,000 house might actually look cheap, especially in expensive cities. These buyers often have strong credit, stable careers, and the ability to save large down payments, which gives them an edge in competitive markets. Investors are also a major force. Real estate investors, private landlords, and institutional buyers purchase homes to rent or flip. Some pay cash, while others use sophisticated financing strategies. Because they treat homes as assets, not emotional purchases, they can move quickly and outcompete regular buyers. This has pushed prices up in many areas and reduced the number of homes available for first-time buyers. People with large down payments are another key group. A big down payment reduces the loan amount, lowers monthly payments, and makes lenders more willing to approve the mortgage. Buyers who received family help, inheritance, or years of savings have a huge advantage. In some cases, parents help with down payments, which quietly creates a gap between those with family wealth and those without it. There are also buyers who locked in lower rates in the past and are now upgrading. Homeowners who bought years ago built equity as prices rose. When they sell, they use that equity to buy another home, sometimes with a large cash buffer. This allows them to compete strongly in the market, while first-time buyers struggle to even enter. Finally, some buyers are simply willing to stretch their finances. They take on high debt-to-income ratios, minimal savings, and financial risk because they believe home ownership is worth it. These buyers exist, but they are vulnerable to job loss, rate changes, and unexpected expenses. So when you ask who is buying homes in 2026, the answer is not the average person you imagine. It is dual-income households, high earners, investors, people with significant savings or family support, and existing homeowners with equity. This shift explains why so many people feel locked out of the housing market, even when home prices like $250,000 sound reasonable on the surface. Affording a $250,000 house in 2026 is not just about luck or timing. It is about strategy, preparation, and understanding how the system works. While the market is tougher, people are still buying homes every day because they approach the process deliberately instead of emotionally. One of the most powerful moves is increasing your income. This can come from career advancement, side businesses, freelancing, or investing in skills that pay more. Even a small boost in income can dramatically improve how much a bank is willing to lend you and how comfortable your monthly payments feel. Over time, higher income also makes saving for a down payment and emergencies much easier. Reducing debt is another critical factor. Every monthly payment you eliminate frees up space in your debt-to-income ratio and makes you look less risky to lenders. Paying down credit cards, refinancing high-interest loans, or delaying big purchases like a new car can significantly improve your mortgage approval chances. Many people focus on saving for a down payment, but forget that lowering debt can be just as powerful. Saving for a strong down payment is still one of the best ways to make a home affordable. A larger down payment reduces your loan size, lowers your monthly payment, and can help you avoid extra costs like private mortgage insurance. It also gives you more flexibility if home prices fluctuate. Buyers with cash reserves can negotiate better and feel less pressure during the buying process. Credit score plays a quiet but huge role. A higher credit score can unlock lower interest rates, which can save you tens of thousands of dollars over the life of a mortgage. Simple habits like paying bills on time, keeping credit card balances low, and avoiding unnecessary credit checks can steadily improve your score over time. This is one of the easiest ways to make the system work in your favor. Timing and market awareness also matter. Some buyers rush in when prices are peaking, while others wait for better conditions or less competition. Watching interest rate trends, housing inventory, and local market cycles can help you make smarter decisions. Even a small difference in rates or prices can change your monthly payment significantly. Finally, mindset is everything. Smart buyers treat a home as a long-term financial decision, not just an emotional milestone. They run the numbers, stress, test their budget, and plan for unexpected expenses. They build emergency funds, think about future income changes, and avoid stretching to the absolute limit of what a bank approves. In 2026, owning a $250,000 home is still possible, but it requires intentional moves. Those who increase income, manage debt, build savings, maintain strong credit, and stay patient are the ones who turn homeownership from a dream into a realistic plan. Let's wrap this up with a clear reality check. A $250,000 house in 2026 is not cheap, but it is not impossible either. The difference between people who buy and people who stay locked out is not just the market. It is preparation, income, debt, and financial discipline. The housing market does not care about intentions. It cares about numbers. If you understand those numbers, you gain control. You stop guessing, you stop hoping, and you start planning. Homeownership is still one of the strongest ways to build long-term wealth, but only when you buy smart and stay within your limits. The goal is not just to own a house. The goal is to own it without sacrificing your future.